Inventory is one of the most important assets for many businesses, but unlike, for instance, cash, the exact inventory balance is not always known throughout the accounting period. As we learned in a prior chapter, under the periodic inventory system, purchases are recorded to the purchasing account in the income statement, and the actual inventory balance on the balance sheet is not updated until a physical count is performed at the end of the period. So once that inventory count has been completed, accountants make adjusting entries to update the inventory account and determine the cost of goods sold. In this video, you'll learn how inventory adjustments are recorded under the periodic inventory system, why these adjustments are necessary, and how they affect both the income statement and balance sheet. The periodic inventory system is used by many small businesses because it doesn't require extensive systems and computer software programs. Under the periodic inventory system, companies do not continuously update the merchandise inventory account on the balance sheet. Instead, all inventory purchases are recorded in the income statement account purchases. And the merchandise inventory account remains unchanged during the period and continues to reflect beginning inventory from the last physical count until the end of the accounting cycle or the next physical count. You can probably already tell that the periodic inventory system can be challenging when you have a lot of inventory, because you never quite know what you have in stock unless you physically count the inventory. Larger businesses often prefer to use the perpetual method of inventory, which perpetually or constantly tracks your inventory. It's expensive, though, to use the perpetual inventory method because you need all kinds of systems in place to track your purchases and your sales. That's why most small companies use the periodic inventory system, meaning you record all purchases to the purchases account and periodically count your inventory. Once the inventory is counted, accountants update the ending balance in merchandise inventory. This adjustment is essential because the ending inventory directly affects cost of goods sold and ultimately net income. So let's talk about counting inventory, which can be surprisingly complex. The first decision is how frequently you'll count your inventory. Many companies count once a year, but not necessarily on the last day of the year, especially because quite a few businesses rely on vendors to provide inventory counters to actually count the inventory. And it would be difficult for these vendors to have the staff on hand to count everything on the last day of the year. Some companies use their own employees, and I've heard anecdotally that sometimes they use salaried salespeople because it doesn't cost them extra because, again, they're salaried. So the company has to decide when it is going to count the inventory and how often throughout the year. Plus, you need a strategy. When will you be counting inventory, for instance, at night or the weekend? And keep in mind that you can't count while you're still open for business, otherwise it will get confusing really quickly. Is the warehouse organized in a way that all inventory can be located easily? You also have to decide how to count partial items. Like when I worked for Kaiser Permanente, there had to be a consistent process for counting partial bottles of medicine or packages of pills or liquids. When I worked for a company that manufactured t-shirt decals that were packaged a dozen to a package, we had to determine ahead of time how we would handle individual decals because sometimes the sales team would open packages to press onto a shirt to show a customer how to handle the decal and the related machine. So there were partial packages. In short, you need to plan for the inventory count and make sure that everyone is on the same page. And on the day of the inventory count, the job is to count every single item. Each unit is then multiplied by the unit cost, which depends on the inventory valuation method used, such as FIFO or LIFO. Some businesses use barcode scanners to help with the count, but Even with technology, it's still up to you to ensure everything adds up, because one tiny miscount could lead to a big surprise at the end of the period. And that's why many companies often team up 2 people for every inventory count to ensure that the count is right. Now comes the fun part, adjusting the books to reflect the new inventory balance. And we do that in 2 steps. The first step is to remove the old inventory balance that's been on the books since the last inventory count. Think of it like clearing off the table before you start a new project. So we debit the income summary account and credit the merchandise inventory. And after recording this entry, your merchandise inventory account should be 0. As part of step 2, we bring in the ending inventory to update the account with what you actually have. We debit merchandise inventory and credit income summary. It's like hitting refresh, make sure your records are current and accurate. In the end, these adjustments ensure that your books match the actual inventory that is on the shelves, in the store, and in the manufacturing area. Let's look at 2 examples. In the first example, the beginning inventory is $125,000 and the ending inventory is $106,119. To record this entry, we first remove the beginning inventory to income summary by debiting income summary for $125,000 and crediting merchandise inventory for $125,000. Then we debit merchandise inventory and credit income summary for $106,119. That means that the merchandise inventory account now shows an amount of $106,119, which is the accurate ending inventory. What about the income summary account? It shows an amount of $18,881, which represents the inventory adjustment to reduce our merchandise inventory of $125,000 at the beginning of the year to $106,119 at the end of the year. The second example is nearly identical except for the amounts. In this case, the beginning inventory was $198,327 and the ending inventory is $152,159. The first step is to remove the beginning inventory to income summary by debiting income summary and crediting merchandise inventory for $198,327. Then we debit merchandise inventory and credit income summary for $152,159. Our merchandise inventory account now reflects the ending inventory of $152,159, and the income summary shows us the inventory adjustment of $45,168, the difference between the beginning and the ending inventory. As you've seen, inventory adjustments play an important role in ensuring that inventory and cost of goods sold are reported accurately. By comparing the inventory records to the physical inventory count and recording the necessary adjustments, accountants help ensure that the financial statements reflect the true financial position and operating results of the business.